Good morning, everyone.
Good morning.
Good morning, sir.
So,
Good morning.
good morning. So let's start for the day. And as I usually do, before we start, there's a 15 minutes of about recap of what we did last week. And also, if you have any questions within these 15 minutes, we can clarify anything before we moving ahead with today's session. So basically, last week, we started with market risk measurement and management. And basically, we discussed what is market risk. And when we talk about market risk of a financial institution, there are 4 key risks. So what are those 4 key risks? Anyone?
Interest rate risk, foreign exchange risk, equity price, and commodity price risk.
Yeah. So the 4 key risks are interest rate risk, commodity price risk, equity price risk, and the foreign exchange risk. So if you look at why we call market risk, the value or the income of the financial institution affected due to the fluctuations of market variables. For instance, you know that whenever the market interest rates changes, there is impact on your interest income and interest expenditure, and ultimately the net interest income, and also the value of your portfolio of assets or liabilities in your balance sheet. And the problem here is we don't have any control over market variables. So that is why we call it market risk. Okay. Then we started with the first one, the interest rate risk, which is one of the most important risks for a financial institutions other than credit risk. Because if you look at many financial institutions, the most important risk appears to be the credit risk, which you will discuss later in a module. Because in most of our banks and financial institutions, the lending portfolio is the key asset. Then, apart from credit risk, when it comes to market risk, the market risk plays an important role because, as you know, all this, even if you take a loan portfolio, or even if your liability side, deposit or any other liability, all are interest rate related, so that there is a significant impact coming from the interest rate risk, because those are linked to the interest rate. So then we looked at in the terms of balance sheet, key element of interest rate risk is arising from the repricing, the maturity mismatch of assets and liabilities, and the repricing of assets and liabilities, repricing of assets and liabilities. Okay. So that's again very important. So there we looked at 2 key risks, the reinvestment risk and the refinancing risk as a result of maturity mismatch. Okay. Then we went to one of the key models, because then we were looking at the different models where we can measure the interest rate risk. So identify how much the impact is like. So there we started with the repricing gap model. Repricing gap model where assets are grouped into rate sensitive assets or liabilities, rate non-sensitive assets, and liabilities are also grouped into 2, rate sensitive liabilities and rate non-sensitive liabilities. So where we take, so what do you mean by rate sensitive? You have to reprice any asset or liability within the particular gap we are talking of is called repricing. Okay. So even in a long-term asset, if it is repriced, within the particular period we are talking of, then within that period, that assets or that liability will be subject to the gap model. So where we try to identify the repricing gap, and when we, for any interest rate changes, we can compute the impact on net interest income. I think all of you can remember. There's a formula is change of net interest income equal repricing gap times change in interest rates. Okay. So this way, depending on your gap in the bank, for any possible future interest rate movements, depending on the market conditions which you forecast, you can have a self-assessment on what would be the impact like. Okay, so that you can manage your asset and liability portfolio. So basically, the balance sheet in a such a way that to minimize any impact. Okay, depending on the expected market conditions. So there again, another important tool, we looked at the C-gap ratio. C-gap ratio is a measure again where any bank can set as a benchmark against the expected interest rate risk. Because you can, as a risk management tool, you can set the C-gap ratio at a particular level. So when you see the actual ratio going to be exceed the target ratio, then that's a risk indicator. That's a or if you see any increasing trend in C-gap over a particular period, then that shows possible threat to your income or your business, your financial condition. So, so that is again an important tool. So we looked at very simple examples of how you can use this model to measure the impact on interest rate. So those are the very basic things we discussed last time. And also one important thing is when we know the gap, in your bank, we can always tell exactly, depending on the movement of interest rates in the market, or the change in interest rate going to be either increase or decrease, what would be the impact. So we can tell beforehand about the impact. So that's the beauty of this particular model, but very simple. Okay. So that's what we discussed last time. And okay. So are there any questions before we move on to the next slide?
So in our previous example, we had three types of assets: that rate sensitive asset, then fixed rate and non-earning assets. Then what are the example of fixed rate assets? It is like a bond with a perpetual cash flow or like that?
Yeah. Now fixed rate. Now here, what you have to identify is not the fixed rate, whether something is subject to rate sensitivity or the repricing or not. So assets which are going to reprice within a particular period, which we want to look at for the risk purpose, is called a reprice asset or the rate sensitive asset. So don't mix up with fixed rate asset or whatever. Even a fixed rate, now for example, what do you call long-term bond, which is going to be repriced within the particular period, is called the reprice asset or rate sensitive asset. Okay. So the important thing is whether a particular asset or liability is going to be repriced during the period. Now, the classic example is if you take, now you are looking at a 1 year time horizon. Okay, your period is 1 year, and there is asset. Now, let's say you have invested in a 30-year treasury bond. Okay, 30-year, let's say 30-year mortgage bond, 30-year mortgage bond. Okay, you have invested, where you get semi-annual interest rate. Okay, semi-annual interest rate. The coupon is fixed to some benchmark rate. Now, say example that this particular 30-year bond, you will get every 6 months treasury bill rate, government treasury bill rate, maybe 1 year treasury bill rate plus 1%. So that is your interest rate. Okay. Now, if you look at the maturity of the bond, it's 30 years. But every 6 months, it is subject to repricing. Because why? Every 6, now let's say you invest today. So after first 6 months, you get, so what is the interest rate you get? TB plus 1 at that time. So let's say 1 year treasury bill rate is 5%. So after 6 months, how much you get as interest is 5 plus 1, 6%. So after 1 year, how much you get?
We don't know. It's
How much?
based on
Huh?
TB plus 1% again.
Yeah. So TB plus 1 minute, TB will not be 5%. No, TB may be 4%.
Yeah.
So after 1 year, you get 4% plus 1%, 5%. So every 6 months, you are subject to repricing. Okay. So even the treasury bond is the mortgage bond is for 30 years. You are subject to repricing within every 6 months. So if you talk about 1 year period, even this asset is subject to repricing. Okay. So that is the idea behind all this exercise. So if you look at a 30-year bond, so that's wrong. When a 30-year bond, if the interest rate is subject to repricing, that is a repriced asset or rate sensitive asset. Similarly, liabilities. Now let's say if you look at you invest in a 30-year loan or 30-year mortgage bond, okay, where you get your interest rate is 7% per annum or 7% paid half yearly. Okay, 7% paid half yearly. So what sort of a asset is that repriced asset or not?
No, it is not subject to the repricing.
Yeah, it's not subject to repricing. Every half year you will get the investor will get 7%, irrespective of the market interest rate. So that bond is quite different. Okay. Now take example of 6 months, 6 months FD, 6 months FD, again fixed interest rate. Bank pays 7% interest rate 6 months. Maturity from today 6 months. So now we are talking of 1 year period. Is it a reprice liability or not?
Yeah, reprice liability.
Why?
Because it is the due to maturity mismatch, it is subject to the repricing.
Yeah. So the asset so basically that's a liability. Liability will mature on 6 months. So you have to settle the liability. Then when you again mobilize another liability to replace that, you may not be able to mobilize it at the same rate. Okay. So that is subject to repricing. So the fixed deposit, but maturing within the 1 year period, subject to repricing. You see? So you have to understand that concept. So what do you mean by repricing? Any asset or liability subject to interest rate, the repricing of interest rate, then that's called the rate sensitive asset or rate sensitive liability. Okay. So then when you do like that, then you identify the rate sensitive assets. That depends on the period you talk of. Now you want to compute the gap for 6 months period, then you should consider only 6 months. Okay. You should consider 1 year, anything subject to repricing, asset or liability within that 1 year is the reprice asset or liability. So if you talk about period of 6 months, let's say you are the risk manager in your bank, you want to look at the rate sensitivity for 6 months. What is going to be the 6 months impact? Then you should only look at the assets or liabilities subject to repricing within 6 months. Okay. Any more questions? No other questions? Okay, so if you don't have any questions, good. So let's move on to the session. Okay. So let's start from where we stopped last time. So we computed a C-gap ratio. So now let's look at what is the importance of C-gap ratio. You all can see the presentation, hopefully.
Yeah, yeah.
Okay. So basically now, as I mentioned 2 minutes ago, it's established the direction of interest rate exposure. So when you look at the number with the target number, you know where you are heading. Are there any threats? Again, you can compute the magnitude. So it can give the magnitude of the exposure. Larger the absolute value of C-gap, larger the expected change in net interest income. So if you have a larger C-gap, so that's the indication of significant impact. Then it provides a crude estimate of the impact of change on net interest income. Okay, so again, rough estimate of the impact. And also, you can use it for peer group comparison. Now, what do you mean by peer group? Any thoughts? What is meant by peer group? Have you heard about peer group?
Industry comparison.
Huh?
Industry comparison.
Yeah. So peer group is no, basically it's rather than peer group similar. I mean, even in industry is a broad one. Now within the industry, even there may be certain institutions similar to your institution. So even in industry, like even if you take a banking sector, not all institutions are like same, similar, even though they are banks. So there may be local banks, there may be state bank, there may be big bank, there may be small bank. So the peer is more narrow, where you have a peer with, you have a comparative, group within your industry. So you can compare with that industry, that group, so that you can see what is level of your risk and how you are doing compared to others. So that's a very good estimate to see the level of risk. Then historical series can be subject to econometric analysis and used to estimate banks' use of the direction of interest rate changes. Okay. So looking at the history, you can do some econometric modeling to see for different interest rate changes what is going to happen and the impact on your bank. Okay. So basically, those are the important points. And this slides again, how do we look at differently about the C-gap? If the C-gap is greater than 0, the positive C-gap, whenever the interest rate movement is upwards, your revenue goes up, your expenditure goes up, and your net interest income will go up. Similarly, if your C-gap is negative and interest rate change is negative, that means reduction in interest rate, your revenue drops, your expenditure drops, but ultimately you end up with a positive net interest income. So in the other two cases, which is highlighted in red arrows, whenever you have a positive gap, but the change in interest rate is negative, that means declining interest rate result in declining revenue, declining expenditure, but declining net interest income. Whenever your interest rate change is, C-gap is negative, for any interest rate increase, so that means change in I is positive, your revenue will increase. Similarly, your expenditure will increase, but ultimately you end up with, even though your revenue increases, expenditure increases, you end up with a negative net interest income. So in broad sense, whenever you know the C gap and the movement of interest rate change or the direction of interest rate change, you know what is going to happen to your revenue, what is going to have expenditure, and what could be the ultimate impact on net interest income. So beforehand, you know impact on your revenue, expenditure, and final net interest income. So that's the importance of this C gap ratio, okay, or the C gap. Okay. Now, in this particular model, we considered the rate changes for both assets and liabilities are same. Okay, if the assets increase by 2%, we assume liabilities would also increase by 2%. So then only we can use this particular C gap model. Change in net interest income equal repricing gap times change in interest rate. But generally, you may not see a parallel, increase for both assets and liabilities in a real market. Okay, this is obvious. Whenever the interest rate declines, you as bankers, what do? When the market interest rate drops, usually what are the things which are going to happen? Usually, what should happen when the market interest rate drop? What is going to happen to your portfolios? What's going to happen? What do you do usually? When the interest rate comes down, what do you do as bankers? No one? Can anybody come up with any answer? Can you all hear?
That means now personal loans, likewise, you promote when the interest rates comes.
You promote? No. Yeah, that's right. No, I am not asking any promotion or any product. But what usually you bankers do when interest rate? I am taking example of interest rate coming down. It could be the same for the interest rate going up. So what you all do? I mean, introducing a loan product is a different aspect, but usually what do you do? You adjust your interest rate downwards, isn't it?
Yeah.
Okay, so that is the basic thing you do. You bring down your interest rate. So you bring down your loan rates and you bring down your deposit rate. So usually how it happens? Usually you will bring down your deposit rate at a higher amount than the loan rates, no? That's what you do. I mean, you may bring down, let's say, market interest rate drop by 2% average. So easily you can bring down your interest rate by 2%. Okay. But usually what happens is your lending rates will come down by 1%. Your deposit rate will definitely come down by 2%. Isn't that so?
Yeah, that's correct.
Yeah, usually it happens. You never bring down. Usually you take the benefit of that also as bankers. Okay. Okay, that's not the right way, but that's usually happens. So in a general sense, whenever the market interest rate changes by a particular amount, the effect on both sides is not the same. Okay, so in the example I gave, the market interest rate comes down by 2%, probably you may adjust your loan rates for the future by 1%, you may bring down the deposit rate by 2%, other one by 1%. Okay, so usually rates may not change in the same amount. Okay, so in that case, we do a modification to CGAP model to estimate the impact. So that's what given this in this particular slide. Look at the last one. If the interest rate change is same for the both assets and liabilities, we can use the simple CGAP model, which we discussed. Change in net interest income equal RSA minus RSL times delta R, means the net impact of interest rate, net change in interest rate. But if you don't see any similar changes for the both assets and liabilities, we can use the below formula. The change in net interest income equal rate sensitive assets times change in interest rate of rate sensitive assets minus rate sensitive liabilities times changing interest rate of rate sensitive liabilities. So you adjust your formula a little bit to consider the different changes in interest rates. Okay. Now, if you look at the previous example, I think if you go to slide previous example, yes, the cumulative gap example of slide 25. Now, earlier we estimated if there is a 1% interest rate movement impact, assuming both assets and liabilities change by 1%. Now, compute the same for the same example. If the rate sensitive assets increases by 1.2% and rate sensitive liabilities increase by 1%. So what would be the impact on net interest income? Okay, so can you work out quickly? If the RSA, the interest rate changes for the assets is 1.2% increase, and the liability side, the increase is 1%. So what would be the impact? Don't look at the next slide, but please work it out yourself to see what is the impact. Anyone got the answer? Anyone got the answer? Anyone? Any answers?
460,000.
Huh? How much? 160,000.
460,000.
460,000. Okay. So if you look at your next slide, it is there. Okay. So now we know our rate sensitive assets in the previous example, 155 million. Now we know the change in rate sensitive assets is an increase of 1.2%, it's 0.12, minus we know our rate sensitive liability is 140 million times. Here the change is only 1%, so 0.01. So your impact is positive impact of 460,000. Because why we have a gap of positive gap in this case. So the positive gap and the interest rate increase, there's interest rate increase, so the impact is also positive. So your bank's income will be increased by, net interest income will be increased by 460,000. Everybody clear? If you have anything, please ask, because otherwise I don't know whether you have a question or not. Please stop and ask. Otherwise, I am moving. If you don't have any questions, okay. So let's look at the drawbacks of the C-gap model. So what are the, even though this is very simple, useful model, any model, there may be some drawbacks. It ignores the cash flow patterns within a maturity buckets. Liabilities are repriced towards the end of the buckets range and assets are repriced towards the beginning. Now, within a bucket, so if you take a little longer term bucket, we simply ignore the repricing pattern of the assets and liabilities. So for example, liabilities may be repriced towards the end of the bucket and the assets may be repriced towards the beginning. So within the bucket, there may be certain significant gap because of the repricing, timeliness of the repricing, so which is not captured. So that's the first thing. The second thing is it ignores market value effects of interest rate changes and net future cash flows. Now here simply, what is the basis we looked at under repricing model? We looked at a particular date, we looked at the balance sheet assets and liabilities, and of the balance sheet asset, we only took the repriced assets. On the balance sheet liabilities, we only took the repriced liabilities, the book value, not any market value or any future net cash flows. Okay. So basically, we didn't look from the market value point of view. Okay. So we only looked at the book value and we compute the impact of net interest income for any positive or negative change. So ignores the future net cash flows. Then fail to deal with the problem of rate insensitive assets and liability cash flows that may be reinvested at current market rate and prepayments that could deviate substantially from the expected cash flow in a non-repayment situation. Okay. Now here only we looked at the rates, the assets or liabilities which are subject to rate sensitivity. Okay. But there are other rate insensitive assets or liabilities where the cash flows, there may be cash flows impact in between the period we are considering. Okay. Now, for example, a fixed rate loan, within a particular period, there are a lot of recoveries in a fixed rate loan. Those are not repriced. Okay. But those cash flows are invested at the current market rate. So that part we don't consider in this model. So if you take a 5-year fixed rate loan, okay, we don't consider the in-between cash flows for this purpose. So that part is not considered. The second thing is, now, even in a fixed rate loan, there may be prepayments. So that part also we don't consider in this model. So in between cash flows of certain rate non-sensitive, assets or liabilities are not taken into account. For example, let's say 2-year fixed deposit with a fixed rate. So within a 1-year period, it is not a rate sensitive liability. But let's say there's a premature withdrawal. So what happened? You are subject to refinancing risk at the market rate, which is not considered here. So those are the couple of drawbacks of this model. But subject to those, this is a very simple model used by almost every bank in any country. I think if you look at, you talk to your risk managers, they will tell you are using this one. Okay. Any questions? Are there any questions? No? Okay. So before we move on to the maturity model, let's look at a question. Let me use some numbers. Give me a minute. I will draw some numbers in the board. Can you all see the board?
Yes, yes.
Okay. So I am giving some, can you see this 3-month treasury bill I have written?
No, no.
No, little.
Huh?
Write it little lower.
No.
Can you see now?
So
Okay.
it's okay.
Okay. So I am giving some example. Let's say you have assets in your balance sheet, 3-month treasury bill, 4 million, 4,000. So these are in millions, thousands. Okay. Then you have a 2-year bond which pays LIBOR plus 1% semi-annually, 10,000. Okay. Then you have a 30-year mortgage bond, mortgage-backed security you have invested, 5,000. Okay. Then you have, let's say, 5 years corporate bond with annual interest rate at TP plus 2%, 6,000. So you have cash, let's say 3,000. Okay. You have a demand deposit in your bank, 2,000. You have fixed assets, 5,000. So your total balance sheet size is 35,000. Then on your liability side, You have 6 months FD. Okay, 6 months FD. 15,000. 1 year FDs 5,000. Okay, 5,000. Then 10-year debenture. Again, semi-annual coupon per month with LIBOR plus 0.5%. 5,000. Okay. You have obtained 5-year loan from bank, 5-year loan from bank at 7% per annum. Okay, 7% per annum. 5,000. And other creditors, $5,000. So altogether, 35,000. Can you see? Okay. So let's assume current market interest rates is 8%. Current market interest rate is 8%, and your economists in your bank have forecasted within next 1 year there's a possible interest rate drop, a possible interest rate decline, and they have estimated if that happens, okay, your assets interest rate will drop by 1.5%. Up to 6.5% on the asset side, and the current interest rate on liabilities 7% will drop to 5%. Okay, so those are the conditions. So your economists have forecasted the current interest rate on your assets 8% drop to 6.5% for over next one year period, and your liabilities current rates you pay 7% will drop to about 5%. So use the repricing gap model and estimate the impact, possible impact on your net interest income over the next 1 year period. Can you work it out? So you have assets, 3 months treasury bill 4,000, 2-year one 10,000, which pays LIBOR plus 1% semi-annual. Then 30-year mortgage bond. Okay, 30-year mortgage bond, fixed rate, 5,000. 5 years bond, which pays annual TB plus 2%, 6,000. Then cash 3,000. Demand deposits you have invested in your banks, other banks 2,000. Fixed assets 5,000. Liabilities 6 months FDs 15,000. 1 year FDs 5,000. 10-year debenture. Semi-annual coupon you have to pay LIBOR plus 0.5%. 5-year loans from bank at 7% per annum, 5,000. Other creditors 5,000, altogether 35,000. So please work out the impact using the repricing gap model. So take about 5 to 10 minutes. So you will see whether you understood the principles and not, and also how you can estimate. Sorry?
It is 200 positive.
No, I don't know. I just work out the numbers. So we will look at you get 200 positive.
Yeah.
So change is increase in net interest income by 200. Okay, so we'll put up 200. Any other answers?
So is it 250 million positive?
Increase or decrease? You have to tell.
Increase, sir.
Increase. So
Increase of 250 million. So I believe so.
250. Okay. And the answer is 250. What about others? What about others? I see about altogether 27 or 28.
170 positive.
170 positive. 170 positive. So net interest income will go up by 170. What about others? Any different answers other than these three? Have everyone completed? All the others got the same answers or different? Any more? Others have not done, or what is the situation? Okay, so let's look at, so first we have to compute the rate sensitive assets over a 1 year period. Now our time horizon is 1 year. So what are the rate sensitive assets? 3 months treasury bond, subject to repricing. Yes, 1000. 2 year treasury bond. Okay. LIBOR plus 1%, semi-annual coupon. Is it subject to repricing over 1 year period? Is it subject to repricing? Huh? Come on. So this is 4,000. Is it subject to repricing? Yes, because semi-annually they fix the rate at LIBOR plus 1%. 8,000. 30-year mortgage bond fixed rate. Is it subject to repricing over next 1 year? No. 5 years corporate bond, annual payments, TB plus 2%. So 6,000 is subject to repricing within the next 1 year, yes?
Yes.
6,000. Cash, we are not doing any repricing. What is it for in our world? Demand deposit, we are not going to do any repricing. Fixed asset, no repricing. So basically, total assets subject to repricing over the next 1 year is 20 million, 20,000, right?
Sir, can you please explain about demand deposit?
Sorry?
Demand deposit, can you please explain?
So demand deposit, we are not going to reprice anything. It's not subject to any rate sensitivity. Do you earn anything from the demand deposit you have?
Okay, okay.
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 So then, rate sensitive liabilities, the liabilities which are subject to repricing over next 1 year, either due to maturity or interest rate adjustment. 6 months FD, so yes. 1 year FD, yes, 5,000. 10-year debentures, semi-annual coupons with like cost 5%, 5,000. Yes. 5-year loan, bank 7% per annum. No.
Yes.
It's okay. Other creditors, no. So our rate sensitive liability is 25,000. Okay. Clear? Then, as per our interest rate direction, now we can't use the simple formula because you see, asset interest rate will come down by only 1.5%, liability interest rate will drop by 2%. So we can't use the very basic model because the interest rate decline for assets and liabilities are different. So we have used other model. So the change in net interest income equal rate sensitive assets 20,000 times change in interest rate of assets, so the drop of 1.1%, that means 0.015 negative, okay, minus rate sensitive liabilities 25,000 times change in interest rate of rate sensitive liabilities 7 to 5% is 2% drop. That means 0.02. Okay, 02. So 20,000. Sorry, it is negative. Okay. So 20,000 into 0.15. How much? $10,000? Is it 10,000? Sorry, 30,000? Huh? this one. 10, 100, 1,000.
30,000.
Huh?
30,000.
Sorry?
30,000.
30,000, okay.
30,000.
30,000 plus, because minus plus. This one how much? 50,000. Is it 50,000? So minus 10,000 plus 50,000 equal 20,000. Is it right? I don't know the numbers. Can't be 30,000. It should be
300 million, is it?
This should be
It's 1.5.
yeah.
0.015.
It should be 500, no? 300 and 500.
300 and 500.
Yeah. So 300 and 500. Yeah. So it's about it's 20. In fact, plus 20. So if you look at thousands, 20,000. 20,000. 20,000. So we work in thousands. So the change in net interest income is increase of 20,000. Got it? Clear? Clear? Any questions? Any questions? No? Okay. So if you don't have any questions, we'll move on to the next slide of maturity gap. Okay. So we will look at the maturity gap model. So what is maturity gap? Now, in this model, what we try to do is estimate how interest rate changes affect the net worth of a firm from a fair value. Remember the previous model, we don't talk about any fair value. We only look at the book value. And we computed the change impact of net interest income from the book value purpose. Now here, what we are trying to do is look at the fair value perspective. So generally, I think there is a great relationship between interest rate and the market value of asset or liability. Okay. So what is the general relationship between the interest rate and the market value of an asset or liability? What is the relationship?
Positive relationship.
Positive.
It's
Okay,
inverse
so,
relationship.
Huh?
It's inverse relationship, sir.
Inverse?
Relationships.
Okay.
Negative relationship or the inverse relationship.
Okay. So one said positive, one said negative. Okay. So it's an inverse negative relationship. When the interest rate rises, the market value drops. When the interest rate decline, market value rises. So there is an inverse negative relationship between the price and the or the market value and the interest rate. So that's why these days, if you have a fixed rate bond portfolio, last few months, your bond managers were happy or not? In the last few months, were they happy or not? If you had a typical bond portfolio for trading purpose, what would have been the interest rate risk? In terms of market value impact? What would have been were there any risks? There was no risk. So how do you perceive the last few months interest rate movements against with your fixed rate bond portfolios?
Yes, sir. Market rate is getting down now, downward trend. So due to that reason, the fixed rate market instruments their prices is going up.
Yeah. So from
So
this
due to that
perspective,
reasons, we are getting some profit on the price increasing.
yeah, exactly. So you are right. So your bond managers were very happy last few months because the interest rates were coming down continuously. So your bond portfolio's value would have gone up and you would have exited the market with a good profit or capital gain. So it was a very good time for the bond managers last few months. Okay. So they were benefiting, the primary dealers, everybody was benefiting from the drop in market interest rate. Okay. So I'm talking about the market value impact. Okay. So it was a good time for them. So why there's a reversal, the declining interest rate and there's the inverse relationship. Okay. The second point you have to remember is longer the maturity of a fixed income asset, larger the fall in market value of asset. Longer the maturity of a fixed income asset, larger the fall in value, market value for any given R increases. Now, the second important theory when we deal with fixed rate, fixed income assets, one important theory is, now the first theory we know there's a relationship negative. Then the second theory is, if you hold a fixed income asset, which is long term, for any interest rate increase, the drop in market value is significant. Drop in market value is significant. Okay. For any interest rate increase, drop in market value is higher for longer term maturity fixed income assets. So, okay. Then the third point is fall in the value of a longer term securities increases at a diminishing rate for any given increases in R. So as you increase the R, but when the R increases further and further, drop in value becomes smaller and smaller. So that's what called falling value of long-term securities increases at a diminishing rate of any given increase in R. Okay. Estimate how the value of an asset or liability changes as a function of interest rate and maturities. Okay. So basically here in this model, we want to look at how the value of an asset or liability changes as a function of interest rate and maturities. Okay. So these are the few relationships. First one, the inverse relationship. The second one, when you hold a longer term maturity fixed income asset, the larger fall in market value for any given R increase. But the third point says the fall in value of longer term securities increases at a diminishing rate for any given increase in R. Okay. So we can use this phenomena to value a bond or fixed income security, any fixed income security. So the value of a bond with 1 year maturity, let's say we have a face value of 100, the coupon rate of 10%. So the yield to maturity is 10%. Now remember, when we talk about fixed income securities, there are two interest rates we are talking of. Okay, so one is called the coupon. So there's a coupon attached to the particular instrument. Okay, where fixed coupon or variable coupon, depending on the bond, what you get exactly over the repricing period. Coupon, that is called coupon. Then there is another term called the yield to maturity. Now, what is yield to maturity? The yield to maturity is the market interest rate prevail at a particular time for such a fixed income security. What the market wants from such security. Okay, so the fixed income, fixed coupon is something where, sorry, not fixed coupon. Coupon is something where you get during every the coupon period. Now, if you take a 5-year treasury bond which pays 8% coupon semi-annually, so you get 4% each 6 months, isn't it? 8% means annual, so 4% each 6 months over the 5-year period. So that is called the coupon. Then yield to maturity is something. Now your coupon is 8%. Yield to maturity, it is at any given point in time, any point of time, how much the market expect as the interest rate from this particular fixed income, or the, in this case, 5-year bond. Okay. So that is the difference. The coupon and yield to maturity, the two things. Both are interest rates. Coupon is fixed, what you get, but yield is what is required by the market. So when the yield changes in the market, what happens? The price of the bond changes up or down. So that's what happened. Now, how did you make a gain out of your bond portfolios last few months? The market interest rate came down. Market interest, but the coupon you get is same, that is fixed. Whether interest rate come down or go up, you get the same coupon. There is no question of it until if you hold it till maturity. Then the price of a fixed coupon investment or security is face value. Face value is the nominal value attached to the security plus coupon. Now here, this example, only 1 year maturity, divided by the yield. R means yield, 10%. Now here both are 10%. So when the coupon and the yield to maturity is same, the price of the bond is equal to the face value of the bond. Why? Because the market, this particular investment give 10%, which is exactly the market requires. So here, there is no difference between the face value and the price. No difference between the face value and the price. Okay, clear? Any questions? Okay. Now let's look at another scenario. Now, interest rate, market interest rate goes up to 11%. The rate was 10%. which is exactly the same as the coupon. Let's say market interest rate increases to 11%. So now what is our price? The price would fall to 99.10. Why? The price equal face value plus coupon divided by the yield. 1 plus R. R is now 11%. So what happened? Now price came down to 99.1, which is below the face value now. Why it happens? Because our market interest rate went up from 10 to 11%, but we will get our coupon 10. So now, why price came down? So this particular bond gives me 10%, but in reality, market needs to pay, from the market point of view, it needs to pay 11%. So as an investor, I will not willing to pay 100 for such a bond. So I will only pay 99.10. Okay. So there is a price drop of 0.9% as a result of increasing interest rate from 10 to 11% for this 1 year bond. So this is a very basic example of a pricing of a 1 year bond. 1 year, I will not say bond, 1 year fixed income security. Now look at this graph. Now this graph is a depiction of number of years and the present value, the price of different interest rate, okay? Now, the interest rates are given 11, 14, 20, and 30. Okay. So what do you see? What is the relationship? Now, firstly, you see there is an inverse relationship. Do you see the inverse relationship? Yes. You see the inverse relationship. Okay. Then, what is the other thing you see? As time goes on, remember the second thing we discussed? As the time goes on, the decline is becoming lesser and lesser. Now let's say, now from first year to second year under any interest rate, drop is sharp. But when it comes from 7 to 8 years, 8 to 9 years, drop, or 9 to 10 years, drop becomes marginal. Okay. Drop becomes marginal. Okay. And when the interest rate, what is the other relationship? When the interest rate goes up, price is lower. Now, if you look at the price of a 30-year bond is much lower than price of a 11% bond. The 11% bond has the highest price, and the relationship is pretty stagnant. But when it comes to higher the interest rate, again, the fluctuation also significant over the years. The last line. Top line is for 11%, the red line is for 14%, green line is for 20%, and the final, maybe pink line, purple line is for 30%. So those are the two things. So change in value of a 10-year bond, coupon 10% with different interest rate. So how a 10-year bond, coupon 10%, interest rate is 11, 14, 20, and 30. So how the price is impacted. Okay. Clear? And this relationship is very important in your interest rate risk management. Okay. When you selecting bonds for your risk management purposes, it's very important. Now, usually the bond is same for a 10-year bond, 10% coupon. When the yield is 11%, price is almost close to 100. But the same bond, if the yield goes up to 14%, the price will be lesser. If the yield goes to 20%, price is almost declined to around 90. If the yield goes to 30%, price is about 85. Okay. So when you go towards the maturity of 10 years, what is going to happen to the price? Price decline is becoming lesser and lesser. Okay. Any questions? Okay. So then the maturity, what the objective of maturity gap model? Now earlier we looked at the repricing gap model. Here we looked at the maturity gap, not the repricing gap. So what do you mean by maturity gap? Here we are not looking at rate sensitive and assets and rate sensitive liabilities. We simply take all assets and liabilities in the financial institution. So we are not going to do any separation for the rate sensitivity. So what we do is we take the maturity of assets in the balance sheet, maturities of liabilities in the balance sheet, and we take the gap. So in this slide, MA means maturity of assets in the balance sheet. So how do you compute the maturity of assets? We take the weight of each asset in the balance sheet, multiply by the maturity of that particular asset, and we sum up all the asset. Similarly, we take the maturity of liabilities for each asset, multiply by weight of that, liability, multiply by weight of that liability in the liability side of the balance sheet. Then we get the ML. Then M gap, or the maturity gap, equal MA minus MA. So when we look at the maturity gap, the number we get tells exactly what would be the impact on our balance sheet. Okay. So there's an example in your handout. So different assets and different liabilities. So we are not worried about rate sensitivity now. So we only want to compute the maturity gap of this particular balance sheet. So we have about 7 assets and 7 liabilities. So each asset, you will see the interest rate, current interest rate, the maturity of the asset in years. So if you look at first asset, the consumer loans, 3 months, the maturity is 0.25. Weight is how much? 17%. From the entire balance sheet, this particular asset represents 17%. So the weight times maturity end up is 0.043. Similarly, for second asset, the weight is 11%. The maturity is 2 years. So the weight multiplied by the maturity is 0.22. So likewise, you have the weight of each asset. If you look at total weight, should be equal to 100. Okay. Then you end up with maturity of assets of 5.12. So the weighted average maturity of entire assets in the balance sheet is 5.120. So what does it mean? On average lifetime of this asset portfolio, average lifetime of this asset portfolio in your bank is 5.12 years. 5.12 years. Then we do the same thing for the other side. So we have 7 liabilities other than equity. So demand deposit, weight is 44%. The maturity is 0.25, average maturity estimated. 0.25. So weight into maturity is 0.110. So similarly, you do the same exercise for all the liabilities. So you ended up with total maturity of liabilities average, total average maturity of liabilities 0.775. So what does it mean? On average, your balance sheet asset side maturity is 5.12. Your liability side maturity is 0.775 years. So this is called the maturity gap. So this is significant gap in this bank. The gap is 4.34. So if you have a higher gap, what does it mean? You are subject to higher risk. If you have a lower gap, you are subject to lower interest rate risk. So the advantage of maturity gap is it considers all the assets and liabilities in your balance sheet. So that's the advantage of maturity gap. Okay. Clear? So as a risk manager, so what is our objective? To minimize the maturity gap. So here what we try to do is we look at the maturity gap and try to reduce the gap to minimize the impact. Okay. So that is the objective of maturity gap model. Okay. Any questions? No. So we will look at another example. Now take an example. The current interest rate in the market is 10%. The current average interest rates are 10%. Now, a bank with asset worth 100, total assets worth 100, the maturity of assets 3 years, and the liabilities worth 90 and equity worth 10, total liabilities and equity worth 100, and the maturity of liabilities 1 year. Okay. Maturity of liabilities is 1 year. So one asset, one liability. The maturity of asset equal 3, maturity of liabilities equal 1. Then what is the maturity gap? What is the maturity gap? Maturity gap how much? How much the maturity gap?
2 years.
Huh?
2 years.
2 years. So simple because one asset, one liability. So maturity gap is 3 minus 1, 2. Now take an example of interest rate rise from 10 to 11%. Now you can work out. Remember the formula we discussed a few minutes ago? Let's say the interest rate increased from 10 to 11%. Okay, the market interest rate rise by 1%. So you can compute and see your assets will, when the interest rate goes up, what happens? Your asset value will come down and your liability value also come down. The asset value will come down to 97.5. Liability value come down to 89.19. So that means our equity value will come down to 8.37. 8.37. So what is the impact on equity as a result of 1% interest rate change on this particular book? Negative 1.63. Negative 1.63. Okay. Or how much? 16% drop. So negative 1.63 means absolute terms, and percentage term, it's about 16.3%. So what do you see? Very simple example. One asset maturity is 3 years. Liability maturity is 1 year. When the interest rate increased by 1%, that is from the current market level, the equity value dropped by 16.3%. So we started the business with 10 million equity, but since the interest rate went up by 1% over the next even one day, our value will come down by 16.3%. So that's a significant risk. So this is a very small interest rate. Now take a hypothetical case where in a highly volatile market, interest rate goes up to 17%. Interest rate could go up to 7%. Now in a highly volatile market, this is possible. Now can you give example of similar thing? This sort of volatility we saw in the market for certain instrument related to Sri Lanka during last few months. Can you give the example where you saw significant volatility of an instrument related to Sri Lanka? Can you give example?
Credit card?
Credit card? No, credit card you don't see. I mean, it's a regulated thing, no? But in the market, it happened. Now, something regulator asks you to do is different. But in the market, this happened due to fluctuation.
Treasury bills?
Treasury bill, you didn't see. I mean, it came down, but not a wide fluctuation. It was continuously coming down, not over last few months.
Is
Around
it FD, fixed deposit?
a specific instrument, there's a significant volatility.
Is it fixed deposit?
Huh?
Fixed deposit FD?
I don't think. Fixed deposit, you maybe about couple of percentages drop, but not a significant volatility.
Loans?
Not really. Loans also may be ups and down, probably downward. There's a particular instrument, the volatility was very significant, enormous. I don't think your interest rate on loan have come down by that much, or FDs have come down by that much. Anything else? Anybody else?
Gold prices?
Huh?
Gold prices?
No, this is interest rate related instrument, not the gold. I mean, gold price gold price went up significantly, but I am referring to the interest rate related instrument. Anybody?
The deposit for foreigners, they want to invest in Sri Lanka rates.
Sorry?
Interest rates for foreign deposits, they call for deposit from foreigners.
Foreign deposit mean your bank's interest, the deposit. No? So again, I don't think that was subject to very significant changes. No answers. No, no one. Okay, this is international sovereign bond, Sri Lankan sovereign bond. Okay, so significant fluctuation of government of Sri Lanka US dollar bond. So there were significant fluctuations. Almost one time it went to yield about 30, almost 30%. Okay, so the price came significantly low. It was pretty cheap in the market because of interest rate. The yield market demand went up, so the price dropped significantly. It was a good opportunity for the, if possible, bankers to look at this bond during past. I mean, now of course it has gained a little bit from the previous level, but about few months ago it was pretty low. Very good price for a foreign as a foreign asset for anybody to keep. Okay, I mean dollar denominated assets. So that is possible. Now with the COVID, everything, that is what happened. I mean, it happened to many other bonds as well, but the impact we had also very significant. So now in this example, I am taking very highly volatile case. Even if you look at certain, maybe if your loans have come down by significant amount or the loans have gone up by significant amount in a volatile market, this could possible. Okay, the fluctuation, but the important fact is the rise in interest rate, which has a drop in value. So if the market interest rate goes up by 7%, what is the scenario? What do you see in this bank? What is the result? If the market interest rate goes up by current level of 10% to 17%, what would be the final result?
Equity amount will come down?
Huh?
Equity amount will come
Yeah.
down?
So what do you see? I mean, what is the level? What is the level of drop?
Assets?
Huh?
Assets value?
Sorry?
Assets value?
I know, but now you said the equity, but what is the impact? What do you see? I just want the gravity of the issue. That's what I am going to explain. What has happened? Bank has become insolvent. The equity value is negative. So the bank started with a 10 million equity, 10 billion, let's say 10 billion. So as a result of interest rate going up from 10 to 17%, what has happened? Bank's equity has become negative 0.8 because the asset value has declined from 100 to 84.53. So the entire capital of the bank has wiped out. You want to see that? The capital is negative. So theoretically, bank is insolvent. The message is very clear. So if there is a significant fluctuation like this in a market, rising interest rate, depending on the maturity gap, your level of risk is enormous. So that is the danger in interest rate risk. You see, that is the danger. So what do you see? For the 7% increase, it could induce insolvency with a maturity gap of 2. So if you have a significant, even a small maturity gap, now here if you look at maturity gap is only 2 years. In the sense of banking function, that is not very big. But what led to this situation? Not the maturity gap. Interest rate fluctuation. So even for a small maturity gap, so that is the danger. Even for a small maturity gap, if the interest rate change is significant, bank can become insolvent overnight. That's the danger. So that's the fact the risk managers have to be mindful. So let's move on to the next slide. Just a 1.5% interest rate change could wipe out a bank with an extreme maturity mismatch. Now, earlier case, we looked at maturity gap is small, but interest rate fluctuation is high. But even if you look at the other way, even a slight increase in interest rate slight change in interest rate, okay, slight change in interest rate could make a bank insolvent if the gap is significantly large. So it works both ways. Even if the gap is small, if the possible interest rate change is higher, it ends up with a disaster. But alternatively, even if possible, now if you look at the 1.5% was a possible thing. You saw this in the Sri Lankan market last few months after COVID. Interest rate changes were more than 1.5%. Okay. So if you had a very high gap, even for slight change in interest rate, you would end up with a disaster. Okay. So what is the message? But we don't have any control. What the bank controller, what control the bank has. So we don't have the control over both factors. Do we? Do we? So we can't control one thing, but we can control the other thing. What is the one we can control? What is the one we can't control?
We can control the maturities of maturity gaps, but we can't control the interest rate movement.
Exactly. So as a banker, we can control the maturity gap because we are the people managing assets and liabilities. So we have a hold on maturity gap. If we feel we have an excessive maturity gap subject to excessive risk, we can do controls. We can change maturity profile in different ways. We will discuss later. Okay, but we don't have a control on the interest rate. So we don't have control on the interest rate. I think few years ago, maybe I can't remember, maybe 10 years or whatever years ago, I think some of you can remember, the cold money rates went up to more than 100%. Remember? Cold money rate went up to more than 100% because there's a short-term liquidity shortage in the market for short term. Almost 100%. So if you want fund for short term, you have to pay 100% interest, which you don't have control. Okay. Did anyone of you have control over COVID? No. You don't have any control. Do we have any control on uncertainty in financial market? No. You don't know. All depend on confidence. Okay. So the message is strategy to correct the mismatches through diversifying across assets and liabilities in terms of maturities. So message is very clear. You only have control on your maturities of assets and liabilities. Diversify in different terms of maturity. You don't have any control over market interest rate. Okay. So it should consider the degree of leverage on the balance sheet. So what is degree of leverage? How much of your assets are funded by equity? How much of your liability assets are funded by debt? And we will move on to the next model where we talk about duration, which is rather fine-tuned model than the maturities of assets and liabilities. and the degree of leverage. So in the maturity mismatch model, what we try to do is we try to compute the maturity of assets and liabilities, and we compute the maturity gap, and we try to see to minimize the maturity gap close to zero. If our maturity gap is zero, what does it mean? Our risk is maintained at a comfortable situation, comfortable level. Of course, we can't fully eliminate the risk because of we manage to bring down the maturity gap or maturity of assets and liabilities. Why? Because even the maturities does not take duration into account. Maturities does not take duration into account. So that's what here called concept of duration. And also degree of leverage in the balance sheet, we don't take into account in this model. But advantage of maturity model is compared to the repricing gap model, it takes into account the market value effect of all assets and liabilities. Whereas in the repricing gap model, we only consider the book value and impact on rate sensitive assets and liabilities. Okay, done? Any questions? No?
So previous example, how we arrived at that 19.5 from 100?
Sorry?
In previous example, our interest rate was increased by 1%. Then as a result of that, our asset value has come down to 97.5.
Yes.
How we calculate that
You
amount?
work out, we will work out, you work out using this formula. This is the formula.
Right.
Okay. So if you
Instead of
plug in the
1
numbers,
yeah,
you will see, you will arrive at those numbers.
right.
Similarly, liability side, you can work out. Okay. So do it in your own. If you can't, we will work it out in the class. So try yourself first. Same principle. Same principle.
So next one, sir, how can we compute the value of the assets for all the balance sheet assets? Because certain assets we are not in a position to assess the market value of that asset, no?
Yes, but if you know the interest rate, you can compute same formula. Yeah. Now here for the what you call maturity of assets and liabilities, you should not worry about. I mean, of course, you can compute the market value of assets given the market interest rate. But important thing is you have to work out the weighted average of particular asset and maturity. But market value, again, you can use the same formula. This is the market value. Okay. For the market value of the asset or liability, you need to know three things. What are the three things? The nominal value of the asset, the given interest rate or the coupon, and the expected market yield. So F denotes the face value or the nominal value. C denotes the given coupon rate. R denotes the market yield. For any asset, you can use it. Okay. Now, for example, I will tell you compute. Okay. Let me put on the board a simple example. Okay, let's do a very simple example. Take a very simple example. Corporate bond. The face value is 1,000. Face value is 1,000. The maturity equal 3 years. Maturity is 3 years. Okay. The coupon rate is 8%. And current interest rate is 7%. So how do you compute the price? Can you compute the price? Market value? Face value 1,000. That, what do you mean by face value? The value you get if you hold this instrument till maturity. So if you buy this today, after 3 years, the maturity is 3 years from today, you will get, so we have to compute the price, you will get 1,000 after 3 years when it is matured. Maturity means maturity. But this bond gives 8% coupon. Fixed income you get on this bond is how much? Let's say annual. Paid annually. Paid annually. Coupon is paid annually. Okay. So what is the price of this bond?
It is the present value of the face value plus coupon interest.
Yeah. So value of a bond is very simple, present value of the bond, which we discussed for 1 year bond. Now, to go to the slide number 35, we compute the value of a bond for 1 year maturity. So before that, let's work out the cash flows. Now we are here. Okay. 0, 1, 2, 3. So what are our cash flows? First year, now let's say I'm going to buy this bond today, which will be maturing in 3 years. So what is my first year cash flow? What is my first year cash flow?
80 rupees.
How much?
80.
80. How did you get 80? 8% of 1,000, 80 rupees, right? I get an inflow of 80. Second year?
80.
80, exactly. Third year?
1,080.
1,080. Huh?
1,080.
1,080 because I get 80 plus this face value, 1,000. So my cash flow first year 80, second year 80, third year 1,080. So what is my price? The price is price equal 80. Now I am bringing that to today's terms, present value. This 80 is today's worth how much? 80 divided by
1.07 power 1.
Yeah, 1.07 power 1. Right. Why 7%? This is the market interest rate, the required rate of return. So we discount by the market interest rate. Then I bring down this 80 I am getting in second year also to today's value, present value. 80 divided by 1.0 to the power
2.
This third year cash flow 1080 divided by 1.07 to the power 3. So this is the price today. So can somebody, I mean the one who spoke now, can you work out and tell me the answer?
It is 1026.23.
Huh?
1026.23.
1026.23. Okay. Hopefully, I think it's the right answer. So what do you see? Now, why this is 1026.3? Why not below 1000? Are you mad?
No, expected rate is far below the coupon rate.
Okay. Expected means market rate.
Yeah.
Yes. You are right. Why? Because the market only wants 7% on this bond. But the bond gives 8%. So bond is trading at a premium to the face value. So that's why if you want to buy this bond, you have to pay a premium over the face value. The face value is 1000. So the price is above the face value. So if you are an investor, this is the price you are going to pay for this particular bond in the market. So today, this bond will trade at this price. Tomorrow, it may be different price because the rate will vary. So this is how you compute the price. So any bond, any fixed, now even a loan you can price. Your 5-year loan, what is the loan price? But now here in Sri Lanka, we don't do any loan trading. But some other countries, loans are traded. Loans are traded. Because here, loans are fixed forever, maturity. But in some countries, the loans are, you can trade your loan portfolio. So when you trade, you have to compute the price. So if you have given a 2-year loan, you can still compute the loan price for the market value purpose. Okay. Any questions? Clear? The guy who asked, how do you compute, clear?
Yes, sir. Okay.
Huh?
Yes, sir. Okay. It's okay.
Okay. So same thing. But of course, in your bank, you don't have to work out manually. If you just plug into the model you use, these numbers will appear. But for the purpose of teaching, this is how you do. But in a real world, in your bank, you don't have to worry about all these compute. If you are a 25-year bond, you have 25 cash flows, discounting, will not be a big problem today. Probably you may have a model, all this. I will work out some Excel worksheets for one pricing when we come to duration. Some questions with Excel worksheets. Probably you have to also work with Excel worksheets. It's pretty simple. Don't worry much. Okay. But for the purpose of learning, so this is the basis. Okay. Any more questions on this area before we'll have a break for the tea break? Any questions before we move on? The next area is duration, new area. No questions? What about others? Others are missing. Cooking. Our ladies cooking. Or preparing cake or something. I don't hear anything from our ladies. Or sleeping, I don't know. So this is the problem is online teaching, Okay. Anyway, so it's 10:35 here in the laptop. So we'll start at 11:05, about 30 minutes break. So you can refresh yourself and look at what we discussed. If you have any further clarifications, you can clear those once we start at 11:05 again. Till then, we'll stop here. Okay. Shall we start after the break?
Yes, sir.
Okay. So, so far we have discussed two models, the repricing gap model and the maturity mismatch model, to estimate the gravity of the interest rate risk. Now, the next model is basically the duration gap model, which we are going to discuss within next 1 hour and so. So before that, are there anything you need still clarification from previous session? No? Okay. So let's look at the duration gap model. Now, okay. Now, what is duration? Now, duration is the weighted average time to maturity on assets or liabilities using the present value as paid. Okay. Now, there is a difference between the maturity and the duration. Okay. Now, maturity is the time stated in the asset or liability which ultimately mature. Let's say 2-year fixed deposit. So what is the maturity of a 2-year fixed deposit is 2 years. 5-year loan. What is the maturity of a 5-year loan is 5 years. So the time stated in the loan. But duration is much broader, where it considers the in-between cash flows of the instrument. As a result, it is defined as the weighted average time to maturity. Now, if you look at 2-year bond, which pays annual interest rate or monthly interest rate. Now, let's say your 2-year FD, your bank has mobilized a 2-year FD, which pays monthly interest rate for the customer. So if somebody has the maturity of the 2-year fixed deposit, maturity is 2 years. But duration is less than 2 years. Why duration is less than 2 years? In between, there are cash flows taking place for that deposit. So duration is weighted average time to maturity. Now, to explain this, now take this 1-year loan. So the bank has given a 1-year loan of 100,000 at 15%, where the interest is paid semi-annually. Okay. So then first year, okay, first year, so the loan is settled. Loan is settled in 2 installments, 50,000 in 6 months and 1 year. Okay. So if you take the maturity of this loan is pretty simple, 1 year. At the end of 1 year, loan will be fully settled. But if you look at the cash flows, after 6 months, you will pay 50,000 and you will pay interest rate at 15% for 6 months, 7,500. So the total cash flows after 6 months is 57,500. Then after 1 year, you will the bank will receive 50,000, the balance 50,000 plus the interest rate for 6 months for that 50,000, that is 3,750. Okay. If you take the present value of the first cash flow is 57, like what we worked out previously, 57,500 divided by for 6 months 1.075, because interest rate is 15%. The first 6 monthly cash flow is 7.5% times 1, 53,490, and the present value of the second cash flow is 53,750 divided by 1.075 to the power 2, because 2 periods. Okay. For the first period, interest rate is 7.5. For the second period, interest rate is 7.5. Okay. So the present value of the both will come to 100,000, which is the loan amount, because the loan is priced at 100,000. But if you look at the cash flows of these two, cash flows equal to 57,500 plus 53,750, 111,250, which is the loan amount plus the interest component. Okay. So if you weight this loan, the cash flows, so out of this 100,000 loan given, you will get 53.49% in 6 months and 46.51% in 1 year. Okay, 53.49% in 6 months, 46.51% in 1 year. So if you weight the cash flows into time basis, so within 6 months, that is 6/12 period, you will get 53.549, and within 12 months, 12/12, that is 1 year, you will get 46.51%. So ultimately, you recover your entire cash flow, that is 100,000, within on average period of 0.7326. Even though we get our loan fully settled after 1 year, technically you will recover your 100,000 within 0.7326 years. So that is called the duration. So if you take this very simple example, on your balance sheet, if somebody asks maturity of this loan, 100,000, is 1 year, but duration of this loan is only 0.7326 years. So duration is generally less than the maturity, unless there could be a possibility duration equal maturity, but it should be less than less than the maturity if there are in between cash flow arising from that asset or liability. So a pretty simple example I gave you to introduce the duration. So duration is a very important concept we use in interest rate risk management, where it takes into capture the real time to maturity. The maturity is the targeted time, but real time is technical time it uses any asset or liability to mature. So if you look at the next slide, when we talk about a relevant instrument, financial instrument or fixed rate instrument, the duration is measured using a pretty simple mathematical formula. So what is the mathematical formula? Don't worry too much about this formula, but you will come to know understanding about this later when we work out some example, probably next week. So duration is, now if you look at, if I leave the first part out, the second part is the summation. Now there is denominator and numerator. Numerator is the top part. The present value of a cash flow times the time of that cash flow divided by the present value of that cash flow is called the duration. Okay, so pretty simple. Numerator equal present value of the cash flow multiplied by the time of the cash flow divided by the present value, ultimately summation of present value of cash flows. So if you look at the denominator, summation equal 1 to capital N, summation sigma, PVT means present value of total cash flow of that particular asset or liability. So what does the denominator indicate? What is the denominator indicates?
Market price of the bond.
Exactly, price of the instrument. Price of the instrument. So if you look at the previous example I put on the board, the present value of all these cash flows when you add together equal to the price, the market value. So in fact, in a duration formula, denominator indicates the price of the particular financial instrument, asset or liability. Okay. The numerator, how do you compute the numerator? You take individual cash flow present value, multiply by time, and then you add together, you get the numerator. Okay. Now, pretty simple. If you put it on an Excel sheet, you don't have to worry too much, even though the formula looks like little horrible. But when you work out through Excel sheets, it's pretty simple. Okay. Now, arising from this, there are some important theories. Now, take example of a zero coupon bond. What do you mean by zero coupon bond? Anybody heard about a zero coupon bond?
No interim cash flows.
Yeah. So there is no zero coupon bond. Is basically a discounted bond, more than 1 year generally, but without interim coupons. So you don't get any coupons on zero coupon bond. I'm very famous instrument in United States and many countries, where you will only get the face value at the maturity. So today you buy at a discounted price, and unless you trade in between, you have to hold it till maturity, and you will end up with the face value. In between, you don't have any cash flows. So if you take a zero coupon bond, the first theory is there is no difference between the maturity and duration. So if I tell you you have a 10-year maturity zero coupon bond, and I ask you what is the duration, it's pretty simple. Duration is also 10 years. You don't have to work out using formula. Why? There are no in-between cash flows. So basically, weighted time to maturity and the maturity also same. So in a zero coupon bond, pretty simple. The maturity equals the duration. Okay. The second thing is, remember previously when we discussed the maturity model, we knew there are some relationship. When the rate changes, price changes. Increasing rates result in declining prices. Declining rates result in increasing prices. And there are certain other things we discuss. Similarly, when the interest rate change, duration also change. That's the second principle. Okay. When the interest rate change, duration also change. So we can adjust our portfolio of interest rate risk management so that we can adjust duration for any possible interest rate changes. So this is, which I already explained. Denominator is the discount present value of a security or its price in an efficient market, the lower part. The numerator is the present value weighted by the length of time it takes to receive the cash flow, which I already explained. So I'm not going to discuss it again. Now again, look at an example. Now take a 10 million loan. 10 million loan given by the bank. The principal plus interest be paid in 20 years. So the principal and interest both have to be paid in 20 years. The maturity equal 20 years. Isn't that so? Okay. Maturity equal 20 years. Duration? How much the duration? How much the duration?
20 years.
Exactly 20 years, because there are no in-between cash flows. So principal plus interest paid like a zero coupon bond. 20 years, no difference. Now look at the second example. Same 10 million loan. You are required to pay 9 million in the year 1, the balance 1 million in year 2. So, little bit hypothetical example, but for the sake of looking at the duration concept, take this example. You give a loan and ask customer, 20 years loan, pay me 9 million in the first year, pay me 1 million in the 20th year. So maturity is 20 years, no difference, because ultimately you will recover your loan in full after 20 years. So maturity is still 20 years, like the first one. Then the effective maturity. Effective maturity is how do you get to a cash flows? Out of 10 million, 9 million you get within 1 year. 1 million out of 10 million you get in 20 years. So very pretty simple terms. Effective maturity is about 2.9 years. This is not the real duration, but duration is something like this. Effective maturity. So if you look at the second example, duration would hang around this number of years. But maturity is 20 years. So it's a significant difference between the maturity and duration. Now, why this is important? Why this is important? Now, when it comes to interest rate risk management under this model, we only look at the duration, not the maturity. Now, take an example. Let's say now you have only this asset in your loan book. The loan, 10 million loan given, 9 million principal in first year, 1 million principal in 20th year, maturity 20 years. Now, if you follow the maturity model, for the interest rate risk management, how do you mitigate your risk under the best possible scenario? If you are a follower of maturity gap model, what if you have only asset in your balance sheet is this asset, and if you use only a liability to manage this, how do you do it under maturity model? Can anyone tell me the best way? Best way. There are so many ways, but the best way possible. What is the best possible way? So what is the best possible way? Can anyone tell the best possible way? If you are a follower of a maturity model, what is the best possible way you can manage the interest rate risk under this scenario? This is the only asset you have. Now you want to look at the liability side and find the tool of maturity, interest rate risk management under the maturity model.
Consider a liability for 20 years.
Yeah. So give me example. Okay, you are right partly. Give me example. You are right. Give me example of that. I mean, practical example. What you express was theory. Practically, how can you do it? Let's say you are the risk manager of this bank. So what is practically, what do you do? You are right, theory right. Tell me a practical example. Actually, how do you do it? ultimately we have to practice these things in our day-to-day business. You are right, but give me the balance part of your answer. Practical, there are so many ways. One way.
Borrow a bond for 20 years.
Huh?
So borrow a bond, kind of, I mean, maybe a foreign bond or a local bond for 20 years to
Yeah, but
refinance.
again, missing. I know the complete answer. Missing certain parts are missing. You know, in reality, you need to have very specific in this case. I mean, with the problem even in exam, unless you are very specific, you will not get the right answer. You have to be, now when you take 20-year bond, there are so many things you have to attach into that. Very specifically, I need. Okay. So we will look at it. The first one, okay. Your example we will discuss a little later, but 20-year bond, maturity, 20-year bond. Okay, right. Then another example, issue or mobilize a deposit, fixed deposit for 20 years. Fixed deposit for 20 years. That again, right.
Okay. So but that in present terms it's difficult, no? 20-year FD, I mean 20-year FD, offering a 20-year FD is
market, I mean, still you can create, I mean, if you have opportunity, you can create fixed deposit, bond, debenture. So given the market, you can, wherever possible, you can do it. If you can't do a fixed deposit, you can do a debenture, you can do a corporate bond. Okay. So any 20-year maturity instrument you will do. Okay. CD or whatever you call. So if you follow the maturity model, you are right. Maturity matching with the maturity of another liability, 20-year bond, 20-year FD, 20-year debenture, whatever you call, you can match it. But when you look at the effective maturity is around 2.9 years. So duration is around 2.9 years. Here this, what you call weighted average, but real maturity also around maybe 2.9 years. So that is the duration. So if you follow the maturity model of we discuss, matching it with a liability of 20 years, what are the issues you will face? Do you think, is it worthwhile, or is there any problem, or is it all right? What things you should see?
Reinvestment risk. Reinvestment risk.
Yes, reinvestment risk is there. Anyway, that very long term. But what are the other clearly seen issue with that?
The interest rate, what you agree?
Yeah, interest rate. Okay, explain me. What is interest rate? Please explain me. Yeah, you came partly, but please elaborate a little bit further. You want to say something, but elaborate what you want to say. I mean, these are things you will face in your day-to-day environment. Okay, let's take now somebody said 20-year bond. Okay, say so you are going to show 20-year bond. Okay, So what are the things you have to consider? Anyone? You came partly, but can you elaborate? I mean, when you want to answer, you have to be very specific. Okay, now 20-year bond, you said interest rate. So you know, if you want to issue a 20-year bond, a debenture, you have to pay a significantly high interest rate, isn't it? Over a 5 now, let's say 5-year bond interest rate you are going to offer is 10%. For 20 years, at least you have to pay 15%. So you have to pay this 15% for 20 years. So you have to incur a pretty high interest cost on this particular borrowing. Then again, this instrument also subject to huge volatility. The longer the maturity, the risk is also high. So volatility would be high over a 20-year period. Okay. And there may be other problems. The demand. Okay. For a demand for now, somebody said it's very difficult to issue a FD for 20 years. Yes. So unless you give a very high interest rate to be attractive, it's very difficult. Demand. So there are a lot of practical issues as well as cost issues. So reality, why you should do that? So since your maturity, effective maturity is 2.9 years, not 20 years. 20 is the maturity, but effective maturity is around this range. Let's say 3 years. If you look at in present value terms, so if you can match the duration, your job is much easier. So you don't have to look at liability with 20 years. If you can look at a liability similar to 2.9 years, your job is very easy. You can reduce the cost significantly. You can market it very easily. There are a number of products, alternatives, which you can do it. So that's why duration is a very effective tool in risk management. Clear? You see the difference between maturity model and duration. So when the cash flows patterns are significantly different, there can be a significant difference between the maturity and duration. So if you follow the duration model, you are wasting your cost. Cost is high and opportunities are less. So again, if you look at few principles, duration of a zero coupon bond is maturity, which I already explained. Duration equal maturity. Now, console bond. So if you take a console bond, it's a fixed coupon each year with no maturity. So there is no maturity, perpetual. In such a bond, maturity is infinite. So it can pass from one to another one. Without the maturity will never end until this world is there, bond will be there. There is no maturity. It's called a console bond. We don't see much in our context, but in some other markets, these are very common. So duration equal 1 plus 1 over R. So duration is 1 plus 1 divided by the market yield. So if you take a console bond with 4% coupon and 5% yield, the duration is 1 plus 1 divided by 0.05 yield. Okay.
Excuse.
Yeah.
In the earlier case, now suppose now we go for 2.79, say 3 years. So after that, again we have to get something for mobilize for another 3 years. No?
No, because you are matching the duration of assets with duration of liability. So at that time, you have to again adjust for your duration, not the maturity.
Right.
Okay. So every time this is a dynamic process. After 2 years, you have to match the duration at that time, not 2 days.
Right.
It's a dynamic process. So as a risk manager, always look at the duration. You adjust your portfolio where possible when you feel there is a significant duration gap. We will come to that later. So there your focus is the duration gap. Okay, so it's not that you replace with another asset or something. So you continuously monitor duration gap and maintain it within the period. Okay.
Okay. Thank you. Thank you.
So this is another example similar to which I worked out earlier. If you take a bond with face value 1,000, maturity 3 years, 10% coupon annually. So what is duration? The numerator is present value of cash flows multiplied by the time divided by the denominator is present value of cash flows. So basically, when you sum up the denominator, you will end up with the price. Now, if you take this particular bond, I'm not going to work out in the whiteboard. So 5%, sorry, 10% coupon. So every year, the investor get 10% of 1,100. So the first year 100, the second year 100, third year 100. In addition, at the end of the third year, the investor will get the face value back, 1,000. So the numerator is first year cash flow, take the present value, is divided by 1.0 power to the 1, because the yield to maturity, the market required rate is 5%, divided by 1.05 to the power 1, multiplied by 1, because the first year. The second year is cash flow is 100 divided by 1.025 to the power 2. That is the present value, multiplied by the time factor is 2 years. Third year, similarly, 100 divided by 1.05 to the power 3, multiplied by the time factor 3 years, third year. Plus 1,000 face value divided by 1.05 to the power 3 times time factor 3 years. So that is the numerator. The denominator is 100 divided by 1.05 to the power 1, plus 100 divided by 1.05 to the power 2, plus 100 divided by 1.05 to the power 3, plus 1,000 divided by 1.05 to the power 3. So when you look at the answer, what is the price of this bond? Can anyone tell price of this bond? What is the price of this bond?
More than 1,000.
Huh?
More than 1,000.
More than 1,000. Anybody? Any other answers? What is the price?
1,136.
Yeah, the price is here. The denominator represents the price. So the price of this bond is 1,136 cents and 16. It is here because always I explained to you previously in this formula, the denominator represents the price, the bottom part. Okay. So here basically the price of this bond is 1,136.16. Why the price is above 1,000? Again, the same thing which I explained. When the market return is only 5%, expected return, the coupon is 10% in this bond. So we have to pay a premium to buy this bond. So this bond is trading at a premium, not a discount. So the duration is 2.75 years. So you see, even though the maturity of this particular bond is 3 years, the duration of this bond is only 2.75 years. So for the interest rate risk management, we should, if we follow the duration model, we go by the duration, not by the maturity. Okay? Any questions? Okay.
So is this Macaulay duration?
Huh?
This calculation is applicable for the Macaulay duration, no?
We will come to that later. Okay. We will come to all those later. Okay. Any other questions? I will come to your point in this slide. Okay. So till then I will skip it. So your answer is here in a slide later. So let's look at features of duration. So what are the relationship between maturity, yield, and coupon? So when we talk about duration, three important things. You always have to be mindful. The maturity of that instrument, yield of that instrument, the coupon of that instrument. So those are the three things we have to be mindful. Okay, first thing, duration increases with maturity at a decreasing rate. Duration increases with maturity at a decreasing rate. So what does it mean? Whenever the maturity increases, duration also increases, but at a decreasing rate. Decreasing rate. So whenever you talk about a very long-term bond, when the maturity increases significantly, the increase in duration is marginal, very marginal. So what does it mean? What does it mean? For your hedging purpose, when you talk about a duration, you don't have to worry too much about a very long-term maturity bond compared to another bond. Let's say for hedging purpose, you select 30-year treasury bond, 30-year government bond, or whatever. So let's say duration of this 30-year bond is 25 years. 25 years. For example, very hypothetical. Maturity 30 years, 25 years. So let's say you are looking at a hedging purpose maturity of 40-year bond. Okay, 40-year bond. But if you look at the duration of that 40-year bond, may be around 26 years. I'm just giving a hypothetical example. So what does it mean? Even the maturity went up by 10 years for that particular bond, duration has not gone up by 10 years. Duration will be only. So, when it comes to hedging means the mitigation of the risk. No point looking for very high-end maturity instrument because the duration increases at a decreasing rate. In mathematical terms, delta D over delta M greater than 0, that means positive relationship. When the maturity increases, duration increases, but the second derivative is less than 0 means the rate of increase is decreasing. Okay, that's the first thing. Clear? The second thing, higher the yield on a security, lower the duration. So if you take two instruments, for the hedging purpose, and you want to look at a lower duration instrument, always look for the higher yield instrument. Because take example of two 10-year bonds, two 10-year corporate bonds. One corporate bond gives a return of 10%. Other corporate bond gives a return of 11%. So two 10-year bonds, one corporate A gives a return of corporate bond of A gives a return of 10%. Second corporate bond B gives a return of 11% yield. Maturity is 10 years. So which one has the lower duration? First one or second one?
Second one.
Second one, because it has a higher yield. So higher the yield, duration is lower. Third one, duration and coupon interest rate. Higher the coupon rate, lower the duration. So same, similar. So if you have two coupon bonds with same maturity, and if you want to select the one with lower duration, select the one which gives a higher coupon. So those are very basic relationship. These relationships are important when it comes to selecting the items for hedging purpose. So you know exactly, okay, this is the relationship, so I must use this particular asset, or I must use this particular liability for my interest rate risk management purpose. Right? Any questions? Okay. So what is the economic meaning of duration? In addition to being weighted average time to maturity of an asset or liability, duration is a direct measure of interest rate sensitivity or elasticity of an asset or liability. So duration is a direct measure of interest rate sensitivity, movement of interest rate. So that's why we use duration as a model for measure interest rate risk. Okay. So duration is a measure of interest rate sensitivity or elasticity of an asset and liability. So duration is approximately, if you look at the notation, I have not put equal sign. I have put equal sign on top of it, some wave-like sign. So duration is approximately equal to change in price of an asset divided by the change in interest rate. Okay, change in price over change in interest rate. So we can readjust the formula. Change in price divided by change in interest rate approximately equal minus D minus sign times duration times change in interest rate divided by 1 plus current interest rate. So that is the technicality behind duration. So someone asked, is that Macaulay duration? Yes. This is called the Macaulay duration. So answer is here. So modified version of the Macaulay duration allows market participants to estimate the relative price volatility. So far we looked at the Macaulay duration. So modified duration is called Macaulay duration divided by 1 plus R. So we can look at the change in price in terms of modified duration times change in R. So where modified duration is Macaulay duration we discussed divided by 1 plus R. So in other words, if you know the duration of a particular asset or liability, we can compute the impact on price for any given interest rate change. Any given interest rate change. Sorry. So is it clear now about Macaulay duration? The guy who asked about Macaulay duration?
Sir, it's okay.
Is that you asked?
Yeah.
Okay. So the Macaulay duration divided by 1 plus R is the modified duration. So if you know the modified duration of a financial instrument, which is basically Macaulay duration divided by 1 plus R, If we know the expected interest rate change, we can estimate the impact on price of that asset or liability. Clear? Very simple. Very, very simple. So this is called the duration model for interest rate risk management. Okay. So I have little bit elaborated, removing the approximate signs. This is approximation. Okay. So where, in very simple terms, delta P over P, if you take an individual asset in a balance sheet, the price change divided by the price equal minus Macaulay duration times change in interest rate divided by 1 plus R, or modified duration multiplied by delta R. If you take a balance sheet of a financial institution, change in asset value divided by the present asset value equal minus duration of assets multiplied by change in interest rate divided by 1 plus R. Similarly, we can apply into liabilities. Change in liabilities divided by liabilities equal minus DL times, DL means duration of liabilities, times change in interest rate divided by 1 plus R. Clear? So this is a pretty simple formula. You can assess the impact of your balance sheet, assets and liability, or individual item in your asset or liability, asset and liability in your balance sheet. If you know the duration. If you know the duration. For the purpose of entire balance sheet asset, you have to compute duration of asset of the entire balance sheet assets. Similarly, you have to compute duration of entire balance sheet liabilities for this purpose. Remember, we computed maturity of assets and maturity of liabilities for entire balance sheet based on the weights. Similarly, you have to do it here. This is called the entire balance sheet hedging. That is called the entire balance sheet hedging. Any questions so far? Okay, it's good. So let's move on to the final formula, where we can use the previous formula to identify the impact of interest rate movement on the equity of the financial institution. So where the change in equity of the financial institution equal minus sign within brackets DA, duration of assets, minus KDL. What is K is given. K is a measure of liquidity, leverage. L divided by A, L means liabilities, A means assets, times duration of liabilities, multiplied by total value of assets, multiplied by rate sensitivity. Delta R over 1 plus R, or any rate sensitivity shock. Basically, delta R over 1 plus R is the interest rate shock. So therefore, financial institution must structure the balance sheet so that DA equal KDL to minimize against interest rate risk. Right? So for any balance sheet, any bank, if we know these numbers, duration of assets, the leverage factor K, duration of liabilities, total asset side, for any possible interest rate shock, we can estimate the impact on equity of the balance sheet, which is delta E. Right? Any questions? So this is the formula which we use under this model throughout our sessions. The formula. So this is the formula we are using mainly during our interest rate risk management using duration. So everybody has to be mindful about this final formula and also the previous formulas for if there's a particular individual instrument. So what does it mean if we want to fully immunize our balance sheet? Fully immunize balance sheet. Fully immunize means? What do you mean by fully immunize? What do you mean by fully immunize?
No impact.
Huh? Yes.
No impact.
Yeah. Fully immunized means, okay, zero impact. Fully immunized, zero impact, no impact. So there is no impact at all. If you want to fully immunize, what you have to do? If you can make fully immunized means no impact means equity will not change. The change in equity will be zero, isn't it? So if you want to make change in equity zero, what you have to do? Can you make A zero? No. Can you make delta R zero? No. You have to make duration gap, which is dA minus KDL equals 0. So if you can structure your balance sheet in a way, dA minus KDL equals 0 or dA equal KDL, you are fully protected against interest rate risk. Fully protected. But in practice, it's very difficult. As a banker, you may not be able to fully protect your balance sheet against interest rate risk. But what you can do is you can minimize the interest rate, duration gap. So if you can maintain DA minus KDL at a fairly comfortable level, then you are safer. Okay, so in your bank as a risk management tool, there may be a number which you said, okay, I want to maintain DA minus KDL at this level, where I feel the comfortable. Beyond that, I feel I am not comfortable. Okay. So that is the objective of a risk manager. Okay. So what are the steps in duration gap analysis? So if you are the risk manager looking at interest rate risk management using this model, what are the things you have to consider if you are going to use this model? You have to forecast interest rate. Because we are looking at not past, we are looking at future. Today I am here. This is my balance sheet today. What is going to happen for the interest rate over next 6 months, next 1 year? So you have to have interest rate forecast. So your economists and experts in your bank looking at the market interest rate, looking at the economy, inflation, many factors, they forecast for the next 1 year period. This is going to be the interest rate scenario. See whenever the central bank make certain announcement beforehand, people used to predict central bank would reduce interest rate over the next 6 months. Central bank would increase interest rate. Central bank rates means the policy rates. Okay, so where you can estimate fairly comfortably the direction of interest rates. One is whether it's going to go up, whether it's going to come down, at what rate. These are forecasts. You may not be exactly right, but some guess estimate. So once you do that, based on that estimation, you can compute market value of assets, liabilities, and the stockholders' equity using the discounted cash flows, which we discussed earlier. So you know the interest rate forecast. So considering that interest rate, you can estimate the market value of bank assets and liabilities and stockholders' equity using the discounted cash flows. Then once you do that, you can estimate the duration of assets and liabilities. You know the market value, you know the duration of asset and liabilities. So the effects of both on and off balance sheet items are incorporated. These estimates are used to calculate duration gap. Then the next step is, once you calculate the duration of assets and liabilities, you can forecast the change in market value of stockholders' equity across different interest rate environments. Then you can forecast how it is going to impact the market value of stockholders' equity or shareholders' funds. Okay. So very simple. You forecast the interest rate, you compute the market value of assets and liabilities based on the forecasted interest rate, you compute the duration, then you estimate the impact of changes on stockholders' equity across the different interest rates. Any questions? The bank can either protect the market value of equity or the book value of net interest, but not both. So you can either protect your book value of net interest income through the repricing gap, or you can protect the market value of equity to the adjustment of interest rate. But you can't do both. So that's why you have to select the right model depending on your purpose. So this already I explained. To protect the market value of equity, bank would set D gap to 0. So D gap to 0 means DA minus KDL equal 0. So in practice, which is difficult, but at least you can maintain at a fairly comfortable level. Now, you have given a hypothetical bank balance sheet. Assets and liability, very simple, basic. You have cash 100. You have given the par value and the market value. Commercial loans 5 years 700. Coupon is 12%. Yield to maturity also 12%. Treasury bond 6 years. Coupon 8%. Maturity 3 years. And yield to maturity 8%. Okay. Market value 200 because YTM and the coupon is same. Total cash earning assets 900. So the weighted average yield to maturity is 11.1%. Market value is 900. Total assets 1000. Similarly, liability side, interest bearing liabilities, term deposits 1 year. Face value is 620, book value, coupon 5%, maturity 1 year, yield to maturity 5%, market value also same. CD 3 years, 300, coupon 7%, maturity 3 years, yield to maturity 7%, so the market value same. Then total interest bearing liabilities, total interest bearing liabilities 920, 620 plus 300. The weighted average yield to maturity is 5.65. Market value also 920 because the yield and the coupon is same. So the total assets and liabilities equal 1000. Now, the last column you have given duration which has been computed. Can you compute the duration of each asset and each liability using the formula we discussed. The number is given, but can you compute it and see whether you get the same number? Can you all do it quickly? Everybody is ready? I have given the number, but see, using these numbers, you get the answer, assuming annual cash flows. Annual cash flows. Let's do the first one at least. The 5-year commercial loans, which pays 12% coupon per annum. The remaining maturity is 3 years. Can you do it quickly? Duration. Are you all with us or are you gone home? Still 20 minutes more. We haven't finished it. So just check whether you get the same number once you do the duration model. So we're pretty simple. Bottom, the numerator is the present value of cash flows multiplied by time factor. The denominator is present value of cash flows, which is equivalent to the price or the market value. Can you do the first one? Commercial loans 5 years, the remaining maturity is 3 years. Quickly, because we don't have much cash flows, only 3 years, I think. Can you do it quickly? Yes or no?
Yes.
Okay, at least one is there. I don't know what happened to others. Okay, so at least try to work it out and see whether you get the number. Okay, please proceed for about 5 minutes. Well, by chance, if you get a question like this in the exam, then you should be able to do it. Because here we don't give you the model or anything in a software. So theoretically, you have to be able to do it. Of course, in the bank, you don't have to worry about calculation. The system will automatically give you the number. But for the purpose of exam, probably if you get a question like this, you should be able to do it. So please work out commercial loans 5 years with 3 years maturity duration. Okay, let's look at how you can work it out. So I have given the working here. If you don't understand, please let me know. Okay. So what is duration? What is the numerator? Numerator is present value of the cash flow multiplied by the time factor. The denominator is present value of cash flows, which is basically the price. The denominator we already know, because in this sheet it is given market value is 700. So we already know market value. Now we have to compute the numerator. So what is numerator? Present value of cash flows multiplied by the time factor. So what is the first cash flow on this loan? 700 into 12%, interest 12%, divided by 1.12, because the yield to maturity is 12%, multiplied by 1. 1 is because the first year. Second year cash flow, again same, 700 into 12% means 0.12, divided by 1.12 to the power 2, multiplied by the time factor, 2 years. Third year cash flow, again bank will get the interest at 12% on this 700. 700 into 12% divided by 1.1 to the power 3, third year. Multiply by 3, third year. Plus third year you will get your loan installment back, 700. So you get your capital back. These are interest rates. Okay. So 700 divided by 1.1 to the power 3 times 3%, the principal amount. So this is the numerator. Discounted cash flows multiplied by the time factor. This is what is stated in the formula. The bottom part, the denominator is market value or the price of the instrument, price of the loan. But here it's already given 700. Okay. So if you work out, you will get these numbers and 2.69 years. It's not difficult thing. Just apply the formula. So duration of this commercial loan, which was a 5-year loan, remaining maturity 3 years, the duration is now 2.69 years. Maturity is 3 years, duration is 2.69 years. If you have only this asset, let's say on this balance sheet, we don't have any other asset. So pretty simple, you can manage it with a similar duration liability. Right? So what went wrong? You can check with your answers. What went wrong? Any questions before we wind up? Anyway, before you come to the class, when you come to the class next day, please work out the rest of the numbers. Because I have given the answers, but work out and come so that if you have any problem, we can discuss. Okay? Before we move on to the calculation of duration gap. So you know exactly if you get a question in the exam, how do you work out the duration of any asset or liability in the balance sheet? Clear? Any questions?
Yeah, calculation part. Yeah, that's better.
Sorry?
Calculation part only. It will be, I think, difficult because it's new to us.
Yeah.
Calculation part is new to me, so try to do it and come.
Yeah, you can work out and see at home. It's pretty simple because present value multiplied by time factor of the entire can. Even if you have a 10-year loan, same thing. But cash flows will run to 10 years. Okay.
Okay.
Then
Okay.
divided by the price. Now here price is given, the market value. If you have not given the market value, simply it is the without time factor present value of cash flows added together. Right?
Okay, thanks.
Clear?
So if you purchase this bond, the par value is 100, par value is 1000, then coupon rate is 12%. Then for the remaining period, if you purchase this bond par value of 1000,
yeah,
they will be receiving 12% coupon at each maturity. 12% for the first year, then second year 112%, then last year 12% plus maturity value.
Yes.
Then why we accrued interest on the 700 instead of the 1000?
I didn't get, because the loan value is 700.
Yeah.
In a loan, there is no what do you call you have to pay the loan amount.
Yeah.
Okay. So today's the loan amount outstanding is 700, which is stated in the book. Okay. So on which only you pay the interest, not on the par value. So you pay the interest on the book value. Okay, book value is 700. Okay. So on 700 you pay 12% interest.
Right.
Okay.
Hello, sir.
Yeah.
So does it require to carry a financial calculator going forward?
Sorry?
Does it, should we carry a financial calculator going forward?
Yeah, you can use, but in the what you call in the exam, you have to work out and see you will get the final answer, but you have to work out and see whether you get the right answer. You have to give the what you call steps. calculator will be given the final answer, but you have to get the steps done, no? Exam, you know, how did you compute? You have to show the steps. I mean, you may get the final answer. There is no harm in it.
Right. Okay, sir.
Now here the par value means the book value of the balance sheet, right? So it's not loan value is 1,000. I think the previous student, misunderstood. The loan value, outstanding book value is 700. Okay.
Which means due to payment that value has come down to 700, no?
Sorry?
Earlier it was 1,000. Earlier it was 1,000. Due to the payment, it has come down to 700. Isn't it?
No. The par value means the book value of the asset, balance sheet asset is 1,000. Book value of the par value means the book value of the balance sheet assets 1,000. No, if you look at the 1,000, the book value, no, the balance sheet. So that is the book value. Par means book value, and here the only advantage is yield to maturity and the coupon rate is same. Coupon rate means interest rate. So that's why the market value also same.
Yeah.
Right?
Yeah.
Par value means the book value of the entire balance sheet asset. Okay, right?
Right.
So please work out whatever the answers you given in the sheet and see whether you get the answers. 4.99. TD1 is pretty simple. Then 2.89 and the weighted average duration of assets and weighted average duration of liabilities, and see whether you can work out the numbers in your own, and then we can compute the duration gap next day. Okay, before we wind up, any more questions, clarifications? Everything is all right?
So in this question, now we have taken 700 as the common loan. So now it has been mentioned as 5-year common loan and the maturity is 3 years.
Yeah, now the remaining maturity is 3 years. Now say loan would have given 2 years ago. So remaining, the maturity means remaining maturity.
Okay.
Always if it is given the original maturity and the because today when you look at, we have to consider remaining maturity. The bond remaining maturity means bond is almost new bond, remaining maturity also. And in a bond, the maturity means 6 years means the original maturity of the bond. Okay.
Okay, sir. Thank you.
No questions. So we'll stop here for the day. If you don't have any more questions. Okay, then we will meet next day. Please work out and see whether you get the answers specified here. If you don't have any problem, that's fine. If you have any problem, let's see what those are. Then we will move on to the more duration hedging concepts and how it has really happened, and we'll work out some examples. And also, please be prepared with the Excel sheet. We will work out some Excel questions next day, practical questions, basic questions. So please be prepared with your Excel sheets. If you don't have Excel in your laptop, please get ready with them next day. Okay, we'll stop here.